Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. This week has been dominated by the US midterms, with a small win likely for the Republicans in the House and a very close race for the Senate. Note, Georgia will likely go to runoff, so we may not even know the full result until December 6th. In all, though, a much better showing for Biden than expected. The Democrats have lost about 9 House seats. Note, the incumbent party on average loses about 26. For the market, this is broadly positive. Historically, investors seem to like split government, with Capitol Hill and the White House in different hands. Political paralysis, it seems, is good for business. More generally, we've continued to see a quiet recovery in equity and bonds this quarter and a stabilisation in the dollar. As I indicated in my last report, this has led us to gradually add back to risk assets. Last month, we topped up corporate bonds in the aftermath of the chaotic trust budget when yields were so attractive. This month, we've moved our equity weightings back to neutral. These small but steady moves have been driven by sharply improving corporate supply chains, falling gas and electricity prices, and more reasonable valuations. We are not, though, out of the woods. And today I plan to tell you what's keeping me up at night and what we at Saracen are doing to mitigate this and protect your portfolios. Let's begin with our regular chart of world markets for the year to date in the left-hand panel. You can see while the indices are still sharply down, we have the beginnings of a rally in Q3 to the right of that blue dotted line. Global equities up in dark blue, gilts up in yellow in the aftermath of the trust budget. Still pressure on Nasdaq in the dark blue there at the bottom, and that green line, US interest rates, another climb upwards to 4% as the steady tightening of US monetary policy drives asset markets around the world. On the right-hand panel, the mighty dollar is at last showing signs of consolidation, possibly even a rollover. This is particularly important for the performance of foreign markets and emerging markets in Asia in particular. Now, as indicated in the introduction, what I want to do today is look at the risks in world markets as we layer in a little bit more exposure to global equities and corporate bonds across your portfolio. Well, risk one I want to mitigate is the collapse in discretionary income in the UK and around the world. And I've used the UK as the key example. You can see in the left-hand panel sharp declines right across the UK. On average, about a 15% fall in discretionary income. That's income after mortgage and rental costs, tax, food costs, electricity, all the essentials, if you like. The collapse in income doesn't respect the normal north-south divide. We've seen declines in the north of England of 20%, but declines in the southeast of England of 22%. Yes, income is higher in the south, but mortgage payments and rental costs are also higher. For a low-income worker in the 20 to 40% band of UK national income, the pressure is particularly acute. We can see that they were showing weekly surpluses of discretionary income of around about £60 just a year ago. Today that's fallen just to £3. So you can see the pressure that is triggering industrial action across the country. Now, from the government side, they need targeted solutions that really hit high pressure wage groups. From us as investors, we need, I'm afraid, to be very careful of consumer stocks in the UK and around the globe. My worry and risk number 2 is the continual pivot from quantitative easing to quantitative tightening as central banks begin to wind down their vast balance sheets accumulated after the financial crisis, as you can see in the left-hand side, and particularly during COVID. This all means greater volatility and reduced liquidity. It was definitely a contributor to the severity of the gilt market problems in the aftermath of the pension crisis a few weeks ago. On the right-hand panel, the IMF has usefully put many of these factors together to look at liquidity conditions across markets, in equities, in sovereign bonds, in corporate bonds and in foreign exchange. Now, you needn't worry about the detail, but it's the colour that's important. The greens and the white showed market depth and deep liquidity only a few years ago. That's pivoted more to reds, showing pressure on liquidity and market depth in general. This means we must concentrate on transparency, liquidity, and focusing on markets where there is a consistent and deep marketplace. It's a worry for private assets, Private equity in particular will see a sharp revaluation. It's a particular worry for crypto assets. Another major exchange failed or has got into solvency problems today, and Bitcoin, of course, is down more than 64% for the year to date. Thirdly and finally, I worry about the climate targets. We just don't seem to be hitting the short-term numbers up to 2030 that put us on track for 2050 to reduce the appreciation in world, or hold the appreciation in world temperatures somewhere below 2%. The IMF on the eve of COP27 in Egypt put out these projections, and you can see the gaps between business as usual and where we need to get to in terms of climate commitments. What does this mean? Well, we need sharply increased capital spending, and we think this is going to be a real emphasis in the next few years. And McKinsey estimates a staggering 275 trillion needs to be spent, or 7.5% globally of GDP every year from 2021 to 2050. We're going to react to this by sharply increasing our exposure to climate stocks after we took them down when valuations got a bit heady 6 to 9 months ago. We're going to begin to see names like Air Liquide, Schneider, Siemens, Ørsted, Weyerhaeuser beginning to appear in portfolios as we build a portfolio for you that can hedge against this long-term climate risk. So putting this all together, we're definitely as investors seeing a light at the end of the tunnel. I think there is opportunity to gradually layer in risk as supply chains ease, electricity and power prices come down and valuations are more reasonable. But we must be aware of the risks. I hope what I've shown you today and the action we're taking to mitigate them will help you to have confidence in your own portfolios and the returns we're hoping to make in the years ahead. Thank you.